Hey, welcome back, everybody. Good morning to all of our options traders. Well, last week I did a video called Rolling for the Wrong Reasons. And in that video, I'd kind of casually mentioned this idea of an overlay. And that's just another word for a phantom trade. Sometimes you'll hear traders refer to these overlays as phantom trades. And I do have a video in here on phantom trades. But the idea is that traders don't really think about what got them from trade A to trade B. They just look at the result. But if you don't understand what causes the changes in those risk graphs, you're not going to understand where those profits or potential losses are coming from. And if you don't understand that, you're not putting yourself in a good position to make good decisions. So I got an email from one of the traders talking about that video and was saying, I don't quite follow this idea of an overlay. Could you give us some examples? So I thought, hey, that's a good idea. If one trader has a question, chances are others do too. So in this video, I want to talk a little bit about some tips, some little drills you can do on your own to practice with overlays. And then I'm going to close to show you a very simple example of why it's so important. So let's get started with practicing with overlays. And before we do, as always, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So let's start off with a simple example. Let's say that you own the $100 call. Here's our risk graph, right? We get our bend right there at 100 at our strike. And let's say you paid $5 for it. So this is the maximum loss over here. And then you sell it later, let's say for $7. So that would be selling to close. You placed a trade in your broker's platform, sell to close for 7, it executes, you paid 5, you close for 7, and you say, I've got a profit of 2. And then this just vanishes from your account. But people don't realize that mathematically speaking, you are long the $100 call and short the $100 call. Now, again, the OCC does not allow this to occur in the same account at the same time. You cannot be long and short the same option in the same account at the same time. They're going to require that those are closed. But from a trading perspective and an educational perspective, it's not really the best way to understand it. Because again, mathematically, this is exactly what's happening. If the OCC allowed you to be long the 100 call and short the 100 call, mathematically you've closed the position. And that's really why they don't allow it, because you would just throw off the open interest. But again, for practice purposes, let's just assume you could be long and short at the same time. So again, notice that you bought the 100 call here for 5, and you have sold the 100 call, let's say, for 7. So that would be a short 100 call for 7. And so here's the trick. This is what we might call an overlay of what I think is a good idea to practice with. And what you're going to do is to locate the strikes. In this case, we only have one strike, that's the 100 strike, but depending on the strategy, you could certainly have more. And you just want to, with your eyes, kind of draw a vertical line right there. All right, now focus to the left. And what do you see? Well, we have a flat line and we have a flat line. Well, those are just zeros. Those are zero deltas. So we've got zero deltas up here and zero deltas down here. In other words, I know for a fact this risk graph is flat for all stock prices to the left of 100. All right, well, now let's look to the right of this 100 strike over here. And what do you notice? Looks like an X. And so over here we have negative deltas. That's like a short stock position. So I could call it -1 or -100 deltas. And that's being matched with what? Positive deltas. That's like long shares of stock, or plus 100 deltas, or just +1. So if you have +1 and -1, what does that sum up to? 0. So what does that tell you? Well, it tells you that for all stock prices to the right of 100, you also have 0 deltas. So that tells me that the entire risk graph is flat. And again, that's why the OCC requires that it is technically closed. But again, if you just look at it that way, that you just closed it, it misses the point. It's because all of these angles are canceling each other. Now we can also dig further to find out the net level. Is it going to shift up or down? Well, in the example, we assume that you sold it for 7 So that's 7 units high right there from 0, and that you paid 5. That's 5 units below. So what's the net between those two? Plus 2. So my resulting risk graph should be a flat line for all stock prices that lines up right here at plus 2. So of course you already know that intuitively. If you bought the $100 call for 5 and sold it for 7, that this is effectively your risk graph. But now you see why. It's because all of those angles in there just cancel out. And so you're just left with the net either profit or loss, in this case a profit of $2. So that's a very simple one, just doing the same option long and short. And go through, line up your strike prices and see if you can figure out what the resulting risk graph will be. Once you've practiced that a few times, you can start doing overlays with other strategies. So for example, let's say that you are long the 95-100 strangle, paid $8 for it, and then you short the 100 straddle for 12. Well, what's the resulting risk graph? Now, once you start getting good with this, I can look at this and pretty much do it in my head and tell you what it's going to look like. So the question for you, though, is what's the resulting risk graph? Can you look at that and tell what the result's going to be? Long the 95-105 strangle and short the 100 straddle? Well, this is where you can practice with your overlays. So here is the long 95-105 strangle. We get a bend at 95. We get another bend right here at 105. Okay, there's our strangle. It's a long call and a put. So the put's going to make money if the stock falls. The call's going to make money if it rises. But if the stock is somewhere between 95 and 105 at expiration, you're going to lose the amount paid, which we assumed was $8 over here. Now, if you short the 100 straddle, this is what the risk graph looks like. You're short the 100 call and short the 100 put. So it looks like this upside down V. And of course, we only have one strike right here, technically two different options, but the same strike. So what would happen if we overlaid these two strategies together? Because that's what we're talking about. We have the long strangle and the short straddle. Well, let's do that. Let's overlay them and see if we can gain some insights into what the result will be from these two trades. So how do we do it? Okay, so here is the overlay of the two strategies. Here are the strikes for the long strangle. There's our 95 put and our 105 call. And then right here at 100, this upside down V, that is the strike for the short straddle. And so what we need to do is now check each of these zones. We have 1, 2, 3, 4 zones to check. Let's do the easy ones first. Let's look out to the left. For all stock prices to the left of 95, what do we see? An X. That's long deltas and short deltas. It just cancels. We have 0 or a flat line for all stock prices to the left of 95. What about to the right of 105? Again, we have an X. We have long deltas here matched with short deltas. Those are going to just cancel. We get a flat line or 0 deltas out there. Let's now check between 95 and 100. We have positive deltas right here, that little angled part, matched with 0. So between 95 and 100, we have positive 1 or 100 deltas. What about between 100 and 105? What do you see? We have negative deltas right there, matched with 0 deltas. It's flat. So that's going to give us, on a net basis, -1. So now it becomes very clear. The line will be flat. The resulting risk graph for all stock prices to the left of 95. We will then slope up to 100 deltas between 95 and 100. We'll slope down, -100 between 100 and 105, and then we'll go flat. What about the net gain or loss? Well, we can see that the peak up here is at 12. Remember, that's where we sold the straddle. The strangle was purchased for 8. So if you paid 8 and sold for 12, that's a net credit of 4. So when we come back over here to our risk graph, there it is. It's a butterfly spread. We have the 95, 100, 105 butterfly. And so that's another insight you can gain from using your overlays. A butterfly is simply a short straddle paired with a long strangle. We have a maximum credit right there of 4 that we saw. Because it's a 5-point butterfly, the maximum loss would be 1. And we also saw for all stock prices to the left of 95, we would have a flat line. Between 95 and 100, we would have 100 deltas, or positive 1. For all stock prices between 100 and 105, we would have negative deltas. And for all stock prices above 105, we would be flat. We had 0 deltas. But again, we don't gain that insight by just looking at the trade. But when you do the overlays, they become very clear. All right, so let me show you a very simple example where using overlays can help you with your decisions for real-world trading decisions. Let's look at rolling a long call. We've talked about rolling lots of times. People love to roll because they say, oh, I'm generating credits. It looks like free money. Well, let's do an overlay and see if that's really what's happening. Let's say that you buy a $100 call for 8 and you roll to the 105 call and you get a net credit of 4. And this is what people focus on. After the trade, they're just holding the 105 call, but they've also got this $4 or this $400 in their pocket. So from most people's perspective, they're saying, well, I had a call before the trade, I've got a call after, but I also got this cash. So it just seems like it's money for nothing. Well, the question that we want to ask here, is this really a $4 credit? How could we answer it? Let's go look at an overlay. So here's the long 100 call. There's our bend at 100, for which we paid 8. So we know the maximum loss is 8. After the roll, you're holding the 105 call. So now we get a bend at 105, but we have an effective cost basis of 4. This was the reason for doing the roll. We want to shift this maximum loss from -8 to -4. So again, traders don't see the overlay between these two. What got us from the black curve to the red? They just look in their account and they see they're long the 105 call, and they also see that their money market has $400 in it. So again, it looks like, hey, this is great. It was just cash. I should do all the rolls that I can. Well, what we really want to focus on to become better traders, ask the question, how did you get from the black to the red? Don't just look and see that you have the red curve. How did you get there? Well, when you had the $100 call and you want to roll it, here's the series of trades. You're long the 100 call, and you would short the 100 call and also buy the 105 call. But we can also do this as a single trade in your broker's platform. That is a short vertical spread. You're just selling the 100-105 vertical. And as soon as you sell that, look what happens. Those cancel. And so you're just left holding the 105 call. But what's the overlay? What did you really do here? You sold the 100-105 vertical. But again, because it doesn't sit in your account, we tend to just overlook it. We just see that I had a 100 call before, I've got the 105 call after. But professional traders are going to understand the trade that linked these two. So let's do that. Let's overlay them. Here's our long call again, 100 strike for 8. And here is the short 100-105 vertical for a credit of 4. We know it's a 5-point spread, so it has a $1 maximum loss. So let's take a look between these two strikes. What do you notice to the left? Let's start over here. Well, we have 0 deltas up here and 0 down here. So for all stock prices to the left of 100, I know my resulting risk graph will have 0. What about between these strikes? See, because we're overlaying these two trades, I can see that I have positive deltas here, and I also have negative deltas. And so those are going to cancel. So for all stock prices between 100 and 105, I will also have 0. What about to the right of 105? Well, I have positive 100 deltas here in black, combined with 0 in red. So on a net basis, I have 100 deltas, or plus 1. So what does this tell you? My risk graph is going to be flat for all stock prices to the left of 105, and then I'm going to have 100 deltas for all stock prices above 105. What if we want to figure out how high it's going to sit up or down on the graph, the net credit or debit? Well, this vertical spread was sold for $4, so that's sitting 4 units or $4 above 0. The initial trade, we paid 8 for right there. So what's the net between 8 and 4? it's going to be minus 4. So I know that this part of the graph will sit $4 down. And so we're going to have zeros, or at least flat parts of the graph all the way up to 105, and then it's going to have positive deltas. So let's do that. Let's combine the red and the black, which remember mathematically is really what happened when we did the roll. And there we go. Maximum loss of 4, and look at that. We are flat for all stock prices up through 105. Now, why is this important? Well, remember when you had the 100 call, your bend was right here at 100. You were able to start making money for all stock prices above 100. But when you do the roll, what happens? Now you don't start to profit until after 105. So we can see that this is the area that we canceled out from the sale of that vertical spread. That's what caused this to flatten out between 100 and 105. So now that we have better insights about this, we can see that we gave up something. See, that doesn't really show up when you say, oh, I still have a call, but I also have 400 bucks. There was a $5 cost for this roll. So when you are rolling, in this example, you're selling the 100-105 vertical, net credit of 4, but the thing you have to understand is you give up $5 of potential gains. That turns out to be important. So you actually have a net loss of $1. See, most people think, oh, I got free money, got $4. Well, overall, you have a net loss of $1 because you gave up. Now, yes, it was an opportunity cost of $5 in exchange for $4 in the hand. But overall, it's a net loss of $1. So really what's happening, the insight here is that the roll is a $1 cost to insure $4. It was a $1 purchase of an insurance policy so that you are guaranteed to not lose more than $4. And so if we go back to the before and after with the roll, we can see it here. If you paid $8 for the 100 call, expiration break even is the 100 strike plus 8 or 108. But when you rolled for a net $4 credit, your effective cost basis is $4 right there. So if you effectively paid $4 for a 105 strike, what's your break even? 105 plus 4, 109. And look at that, they are separated by $1. See, there's actually a $1 cost to get that $5 roll. But you'll never see that if you just say, I want to roll for credits. So another point to take from this is you have to be very careful about doing aggressive rolls, doing a $5 roll for a $1 credit. I see traders doing that all the time. And they justify it by, hey, money's money, might as well pick it up. But they don't realize that in that case, it's a $4 policy to insure $1. And if you're paying $4 to insure $1, you're going to end up losing money even though you're focused on the credits. This is why overlays can help you make better decisions, and when you're making better decisions, you'll have more consistent profits. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.